Every financial earthquake begins with the same pattern. Not dramatic headlines or obvious signals, but quiet leaks that reveal what institutions actually believe when they assume nobody else is listening. Today, that pattern activated in precious metals markets through a single leaked document that could fundamentally alter how silver markets operate over the next 90 days. An internal Bank of America commodities assessment, intended for institutional clients only, surfaced containing analysis that contradicts everything the bank has publicly stated about precious metals pricing over the last 12 months. The leaked document projects silver reaching $150 per ounce by April, based on what BofA internally describes as supply deficit mathematics that render current pricing models obsolete. $150 by April. That's a nearly 40% increase from current levels within 90 days. Projected by an institution that has publicly maintained silver price targets in the $80 to $90 range. The discrepancy between public guidance and private assessment suggests that Bank of America has fundamentally changed its internal evaluation of silver market dynamics, while maintaining public positioning that understates the magnitude of that change. And when major financial institutions provide different analysis for public consumption versus internal decision-making, it typically indicates that market conditions have shifted beyond conventional analytical frameworks. But the significance of today's leak extends far beyond Bank of America's pricing projections. The significance lies in what the leak reveals about institutional understanding of current silver market structure and why that understanding points toward buying panic rather than gradual price appreciation. Because Bank of America isn't just providing price targets. Bank of America is describing mathematical conditions that make current silver prices unsustainable, regardless of institutional preferences or market manipulation efforts. And when mathematics constrains institutional options, institutional behavior typically shifts from market management toward market adaptation very quickly. The leaked document describes what it terms supply deficit mathematics as the primary factor driving revised price projections. This suggests that Bank of America's internal analysis has concluded that silver supply and demand dynamics have reached mathematical breaking points that cannot be resolved through normal market mechanisms. Supply deficit mathematics, not temporary supply constraints, not cyclical demand fluctuations, mathematical relationships between available supply and required demand that point toward resolution through price adjustment rather than supply expansion or demand reduction. When major institutions start using mathematical language to describe commodity markets, it indicates they've moved beyond traditional supply and demand analysis toward recognition that physical constraints are imposing outcomes regardless of financial market preferences. And physical constraints, once recognized by institutional analysis, typically trigger institutional positioning changes that create exactly the buying panic conditions that individual investors fear most. But to understand why Bank of America's internal assessment points toward buying panic rather than orderly price appreciation, we need to examine what supply deficit mathematics actually means when applied to current silver market conditions. Current silver market dynamics reflect mathematical relationships that have never existed simultaneously in precious metals history. Industrial demand exceeding annual production by approximately 200 million ounces. Investment demand accelerating rather than declining despite price appreciation. Strategic demand from governments and institutions, recognizing silver's role in technological infrastructure and monetary systems. These demand categories don't operate independently. They reinforce each other through mathematical relationships that create compound pressure on available supply. When industrial demand exceeds annual production, available supply must come from existing inventories. When investment demand accelerates, available supply faces additional pressure from financial buyers. When strategic demand emerges, available supply confronts buyers who prioritize acquisition over price optimization. The mathematical result is inventory depletion at rates that approach complete exhaustion within timeframes measured in months rather than years. Current COMEX registered silver inventories represent approximately 4 months of industrial consumption at current rates. If investment demand continues at recent levels while strategic demand increases, available supply could exhaust entirely within 6 to 8 months. This mathematical timeline creates what Bank of America apparently recognizes as supply deficit mathematics. Not eventual scarcity, but mathematical certainty that current consumption rates exceed available supply within analytically determinable timeframes. A mathematical certainty about resource exhaustion typically triggers institutional positioning well in advance of actual exhaustion to avoid being forced into panic buying when exhaustion becomes obvious to all market participants. This explains why Bank of America's internal assessment projects $150 silver by April rather than gradual price appreciation over longer periods. April represents approximately 90 days from current date. 90 days provides sufficient time for institutional positioning before supply exhaustion becomes undeniable to broader market participants. The leaked assessment suggests that Bank of America believes institutional positioning must occur within the next 90 days to avoid competing with panic buying from investors who recognize supply exhaustion only after it becomes mathematically obvious. But institutional positioning at the scale required to hedge against silver supply exhaustion creates its own market dynamics that typically accelerate the very outcomes that institutions are attempting to prepare for. When major financial institutions begin accumulating significant precious metals positions, they don't accumulate gradually over extended periods. They accumulate rapidly to minimize price impact from their own purchasing activity. Bank of America manages commodity exposure for pension funds with hundreds of billions in assets, sovereign wealth funds with trillion-dollar portfolios, central banks with strategic reserves measured in hundreds of billions, insurance companies with massive long-term liabilities requiring inflation hedging. If these institutional clients follow Bank of America's internal assessment and begin silver accumulation targeting April positioning, the combined purchasing power could overwhelm available supply within weeks rather than months. An overwhelming available supply within weeks creates exactly the buying panic conditions that transform gradual price appreciation into vertical price movements. This appears to be what Bank of America's assessment anticipates. Not gradual movement toward $150 silver, but rapid movement triggered by institutional recognition of supply mathematics, followed by panic positioning before supply exhaustion eliminates positioning opportunities. The mathematical progression is straightforward. Institutional assessment leads to institutional positioning. Institutional positioning overwhelms available supply, overwhelmed supply triggers panic buying. For market participants who recognize the positioning activity, panic buying drives prices to levels that make current prices appear historically insignificant. Bank of America's $150 April target may represent conservative projection based on institutional positioning alone, without incorporating panic buying from broader market participants who typically respond to institutional positioning with accelerated acquisition efforts. If broader market panic buying develops in response to institutional positioning, prices could exceed Bank of America's conservative institutional targets by substantial margins. But the most significant aspect of today's leak isn't the price projection itself. The most significant aspect is the institutional acknowledgement that silver markets have transitioned from manageable supply and demand dynamics to mathematical supply exhaustion scenarios. This acknowledgement represents fundamental change in how major institutions evaluate precious metals markets. Change from treating precious metals as portfolio diversification instruments to treating precious metals as strategic necessities for protecting institutional assets against monetary system breakdown. When institutions transition from diversification thinking to strategic necessity thinking, their allocation patterns change dramatically. Diversification allocations typically range from 2 to 5% of total portfolio value. Strategic necessity allocations can range from 15 to 25% or higher, depending on institutional assessment of systemic risk. If Bank of America's institutional clients follow internal guidance and increase silver allocations from diversification levels to strategic necessity levels, the combined capital flows could approach scale capable of absorbing total available silver supply within extremely compressed timeframes. And absorption of total available supply by institutional capital creates conditions where remaining supply commands prices that reflect scarcity rather than historical precedent or analytical models. This explains why Bank of America's internal assessment describes current pricing models as obsolete. Pricing models based on historical relationships between supply, demand, and price become obsolete when mathematical supply exhaustion eliminates the supply side of the equation. When supply approaches exhaustion, pricing models must reflect scarcity mathematics rather than traditional supply and demand analysis. Scarcity mathematics typically produce price outcomes that exceed traditional model projections by factors of 2, 3, or more. Bank of America's $150 projection may reflect scarcity mathematics rather than traditional precious metals analysis. If accurate, it suggests that silver pricing has transitioned into mathematical territory where traditional analytical frameworks provide limited guidance for price discovery. But scarcity mathematics, while providing directional guidance toward much higher prices, cannot precisely predict timing or magnitude of price movements, because they depend on behavioral responses that mathematical models cannot quantify. Institutional positioning speed, panic buying intensity, regulatory intervention probability, alternative supply development, demand destruction thresholds, these variables interact in ways that mathematical models cannot precisely predict. However, mathematical models can identify ranges within which outcomes must occur based on physical constraints. Bank of America's assessment appears to reflect such constraint-based analysis rather than traditional econometric modeling. The constraint-based approach suggests that silver prices must reach levels sufficient to either trigger demand destruction accelerate supply development, or eliminate financial speculation in favor of industrial and strategic buyers only. Current silver pricing attracts financial speculation that competes with industrial and strategic demand for limited supply. Higher prices that eliminate financial speculation reduce total demand while prioritizing supply allocation toward industrial and strategic buyers who cannot substitute alternatives for silver requirements. Bank of America's $150 target may represent the institutional assessment of price levels required to eliminate financial speculation while maintaining adequate supply for industrial and strategic requirements. If accurate, it suggests that silver markets are approaching transition toward pricing that serves industrial and strategic buyers rather than financial speculators. This transition typically occurs rapidly rather than gradually because financial speculators typically exit markets simultaneously when price levels exceed speculative profit thresholds. When financial speculation exits precious metals markets, available supply increases for industrial and strategic buyers, while price volatility often decreases despite higher absolute price levels. The net effect creates market conditions that favor long-term institutional positioning over short-term speculative trading. Bank of America's internal assessment may reflect institutional recognition that silver markets are approaching this transition point, and that institutional positioning must occur before transition completion to secure adequate long-term supply at acceptable price levels. But institutional positioning based on supply exhaustion mathematics typically creates self-fulfilling prophecies, where institutional buying activity accelerates the very supply exhaustion that motivated the positioning in the first place. Today's leak may trigger exactly such acceleration by alerting other institutional participants to Bank of America's assessment and encouraging parallel positioning efforts before silver supply exhaustion eliminates positioning opportunities. The mathematical result would be multiple major institutions competing for limited silver supply simultaneously, creating buying pressure that overwhelms available supply within time frames much shorter than Bank of America's 90-day assessment period. Compressed timeframes typically produce more volatile price discovery than gradual timeframes. If institutional positioning accelerates beyond Bank of America's projected schedule, price movements could exceed institutional projections within compressed timeframes. The combination of accelerated institutional positioning and compressed timeframes often produces exactly the buying panic conditions that transform institutional price targets into conservative estimates rather than aggressive projections. Bank of America's $150 April target may become conservative baseline rather than ambitious projection if today's leak triggers institutional positioning acceleration across multiple institutions simultaneously. Because when institutional panic buying begins, it typically continues until available supply exhausts or prices reach levels that force institutional rationing of acquisition activity. Current silver supply levels, combined with potential institutional demand, suggest that rationing would occur at price levels substantially above Bank of America's projections. The mathematical possibility exists for silver to reach $200, $250, or even $300 per ounce if institutional positioning triggers buying panic that exhausts available supply before demand destruction occurs. Whether such extreme outcomes develop depends on institutional responses to today's leak and whether other major financial institutions have reached similar mathematical conclusions about silver supply exhaustion. The evidence suggests they have. Bank of America rarely operates alone when major market transitions occur. Institutional consensus typically develops before individual institutions begin major positioning changes. Today's leak may represent disclosure of institutional consensus rather than individual institutional analysis. If institutional consensus supports supply exhaustion, mathematics, and strategic necessity positioning, the combined institutional buying power targeting silver accumulation could overwhelm global supply within weeks, regardless of price levels. And overwhelming global supply through institutional buying typically produces price discovery that makes previous analytical frameworks appear historically quaint. Bank of America leaked assessment, silver to $150 by April. Institutional mathematical consensus, supply exhaustion within quantifiable timeframes. Market implication, buying panic approaching. Individual investor option, position before institutional panic, or compete with institutional panic. The leak revealed institutional thinking. Institutional thinking revealed mathematical reality. Mathematical reality points toward outcomes that make current prices appear insignificant. The buying panic begins when institutions begin positioning. The leak suggests positioning begins immediately, 90 days until April. Mathematics suggests much less time until supply overwhelms. Bank of America provided the timeline. Mathematics provides the outcome. The convergence approaches rapidly. Position accordingly. Or observe from the sidelines while mathematics overwhelms markets and previous price levels become historical curiosities. The leak was the warning. The mathematics are the reality. The panic is the outcome. Bank of America to $150 by April. Mathematics suggests higher, faster. The leaked projection was conservative institutional guidance. Reality tends to exceed conservative institutional guidance when mathematics constrains outcomes. Silver to $150 by April was the institutional assessment. Silver beyond $150 before April may be the mathematical reality. The leak provided institutional thinking. The mathematics provide the timeline. The buying panic provides the acceleration. Don't confuse institutional projections with mathematical outcomes. Mathematics typically exceeds institutional projections when supply exhaustion mathematics determine price discovery. The leak revealed institutional understanding. Understanding typically lags mathematical reality. Mathematical reality suggests the buying panic has already begun. The leak simply made it visible. Bank of America, silver to $150 by April. Mathematics, silver beyond projections before schedule. Choose institutional guidance or mathematical reality. Reality doesn't wait for institutional schedules. The buying panic acceleration begins now, whether institutions are ready or not. Mathematics doesn't accommodate institutional preparation time. It simply overwhelms markets according to mathematical timeline. The timeline accelerates. The panic intensifies. The outcome approaches. Bank of America provided the warning. Mathematics provides the result. Position before mathematics overwhelms everything else, including institutional preparation time. The leak was yesterday's news. Mathematics is today's reality. Tomorrow belongs to whoever understood the difference and positioned accordingly, while positioning was still possible. Before panic eliminated positioning opportunities. The countdown began with a leak. Mathematics determines when it ends, and mathematical endings rarely accommodate individual investor convenience. Position now, or observe later. Mathematics doesn't provide third options. The leak guaranteed that, whether anyone was listening or not.